if you listened to the Fed testimony yesterday, Janet, yeah, I did listen to it. I was listening to it on the in the car on the way out here. And one of the things that struck me, I didn't hear too much of the TV talking heads discuss this, but as usual, I caught it. Janet Yellen, for the first time, at least in her testimonies that I've heard, acknowledged the fact, kind of subtly, that the unemployment issue might not just be cyclical, which means it has ebbs and flows with the business cycle, but might be more structural. And she discussed technology being a sort of like a disruptor. Now that is absolutely huge, because she also acknowledged that the unemployment rate is sort of baked. She mentioned that the I don't really I'm trying to think of her exact wording. It escapes me at the moment, but basically what she said was that the numbers are understating the unemployment issue. Now, if that's the truth, I might have to revise my lower for longer thesis to lower for life, because if there is structural unemployment, it can take decades to get out of. Now, I don't necessarily know if the Fed is going to stay on hold at zero for decades, or even for more than, maybe a few months or years, but it definitely has me thinking that the Fed is in no rush to raise interest rates here. She also acknowledged a possibility of an economic shock causing trouble. Define structural. All right, so structural unemployment. Cyclical is when it ebbs and flows, sort of like your basic sine wave with the economy. And structural means that people are not trained or geared for the right jobs anymore, and they might not be relevant to the labor force in the way that they used to be. Think about this. You might have a factory that produces buggy whips, and as you're moving from horse and carriages to automobiles, they might make the best damn buggy whips, but nobody's going to use them anymore. To use a little bit of other people's money analogy here, that's one of the financial movies that doesn't get as much play as it should. But that is structural unemployment, and that is really the Fed's fear. So they were also discussing, and Janet Yellen acknowledged this, that the risk is to raise too soon. She acknowledged that the risk that they face is to raise too soon, and that they risk having to reverse policy. So my thinking, and Jeff Gundlach, who's a big hedge fund manager who's known as the bond king, quote unquote, echoed that sentiment on TV the other day. I'm usually a little bit critical of some of these big guys because they talk their books, but I happen to agree with a lot of the stuff he was talking about, and he echoed a lot of the sentiment that I discussed. And if you take a look, with all the hullabaloo of people saying that rates are going higher, rates actually have gone lower since her testimony. You had a pretty big engulfing candle yesterday. Today you had some follow-through. It kind of stalled a little bit at the 50-day. The one thing that has me a little bit cautious is that the lows on the TLT aren't really secure. There is a bit of a look below from the 26th, but it's not as elongated of a tail as I would have liked to have seen. So if you do take that area out again, I'm going to have to revisit the lower for longer thesis. The risk then to me would be into the 113s, and then we might have to discuss. As of now, I would say that the channel high in TLT could be in play, and that would coincide roughly with the 2009 high, which was 123.15. So somewhere between those 122s and 123s could be some upside projections, believe it or not, in TLT if rates are to test back lower. Now, there's a couple of things there's a little bit of loose change in the markets that I want to discuss. Moving away from the Fed and the macro policy, although I will say I think that her comments yesterday were rather dovish. I know that most of the TV talking heads who get paid to listen to this stuff and to give you their commentary will probably disagree with my analysis, but until my analysis to me proves that I'm wrong, I'm going to stick by it. And to me, I heard dovish. So I think the Fed is probably on hold for a little while. I think that they kind of want to give the impression that they want to raise. I don't necessarily know that they really do want to raise. And they should be careful what they wish for, because deflation is a lot harder to stamp out than inflation. Inflation, you just raise interest rates, really easy tool to take care of. Deflation, whole other ballgame. One other thing that isn't really being commented on, it was discussed a little bit in her testimony, and I was really excited. Actually, some of the congressional comments for once were actually fairly intelligent, and they were talking about if they raise interest rates, that what effect would that have on our debt payment. And the truth is that the more interest rates go higher, the closer we are to trouble, because that means that the percentage that we pay of our GDP to service debt goes significantly higher, and then you start coming into like a Greece type of situation. I don't think the US is Greece, just because we have a lot more natural resources than they do, and there's a lot of other mechanisms we can pull in our economy that the Greeks cannot. Anyway, let's get off this macro for a bit, and let's just jump into some levels here. So I want to start out with SPY. I always like to discuss SPY. That's sort of the my S&P proxy that I use. I mean, a lot of people can use futures. Some people like to use the SPX. I don't mind using SPY. So we are not yet to the sort of the downtrend line fully yet. We're getting close. It's not really a very steep downtrend line. It's sort of like, it's almost like a level downtrend line. And one of the things that I would say was a little bit disturbing today was that you had Google up ginormous. I mean, the stock was supposed to move like 20 something bucks. I have to check what the measured move was, but it clearly blew through it. I mean, you moved up almost $100 today. And I think that that was what fueled the rally today in momentum. You had really a big, strong move from Netflix the prior day, and you also had the move in Google. Yes, it's about 3 standard deviations. It was a really, really ginormous move. And as we all know, Apple and Google and Facebook are highly weighted in the QQQ, which is the NASDAQ 100 ETF. And I believe that was really what fueled the rally today, the proxy. Because if you look at SPY, it really didn't do very much. And IWM was a little bit weak. I'm going to discuss that in a moment, and the implications that that may have. So the real action is, of course, happening on the NASDAQ. So anyway, with SPY, one of the things that had me concerned was that we, or I shouldn't say have me concerned, but we've moved a lot. You had pattern failure a few days ago. A lot of people were pressing short. We got down into that 61.8 Fibonacci retracement that I had discussed. We got really close to the reference lows, and then we reversed pretty strongly. So everything has been going according to plan. The level here that I would say that you kind of have to clear for the bulls, and we kind of looked, I believe we did look a little bit above it, but we closed actually right on it. I'm gonna show this in my Sunday video, and it's just gonna be like, wow, like, you know, that these levels really work. The 212.48, that was the sort of the old high before the sort of quote-unquote head and shoulders top, and as long as you can keep price over the 1248 level, that negates any potential head and shoulders pattern. I said I didn't really think that we had a head and shoulders pattern in place. I just thought we had a bit of a lower high and we were kind of pulling back, but this would negate that pattern. That would also put a move to the all-time highs into play, which would take you back roughly up to the 213. Now this week, what I was seeing in open interest, and I had discussed this in the video and in tweets on the stream, was that I saw 210 and 212 being the kind of the key levels, and this was all tweeted out well ahead of time. And I said that I thought a pin at 210 would fudge a lot of people, but if we cleared the 210s, that 212 would be the resistance, and it was today and yesterday and today. The options, you know, opinions and people lie, but the OI never does. So the OI, I want to just give you an idea of what I'm seeing. This is actually going to be a live read of the OI. I haven't really been I haven't really been looking at this all day. Hold on one sec, I'm sorry, just bear with me a moment. The 212, I'm just curious to see the volume and the open interest. Yeah, it's not really that conclusive, although the same issue seems to be developing in terms of the open interest, that you have a lot of OI for next week, particularly on the put side. A 210 is a big magnet, and also even down to 209. So I think, and then there's a lot actually in the 207s. So if there is some type of a liquidation break, the expected move next week is, this is impossible. Wow, it's tiny. It's only 2.2 $2.2 in the SPY. So I would say that the same thing is sort of developing, where you'll have some support within this range. That's a little low because the IV, the VIX got creamed so badly the last couple days. I mean, we did get that run up to the 20s, and then today we actually made some fresh lows. It was pointed out to me by Will in the stream, which is very nice of him. I hadn't even, honestly, I hadn't noticed it until he mentioned it. But VIX made some fresh lows here. It wound up rallying a little bit off of those lows, but we did make new lows. So we are now in a pattern in VIX where it sort of ballooned up and now came back down. I would say the fact that the pattern broke in terms of the higher highs and the higher lows, and now that we're making newer lows, I would say VIX here is too low to sell. It's obviously in the lower part of the distribution, and I would say the risk here is probably for a move back sort of toward the middle, maybe up to even back up to the 15s, believe it or not. So I would not be looking to sell any premium here. I'd be looking, if anything, to buy, maybe put on some protection, particularly in SPY. It's very cheap here if you want to carry longs. With regard to SPY, like I was saying, I think that the do or die here is going to be if we can hold the 212s and the 210s. If we lose 210s, then I think we're going probably to 207s, believe it or not, for a bit of a larger liquidation break. Because 210 had been the old support, it should have served as resistance, and now that we're cleared, it should be support again. If that breaks, I would say that we're looking at a bit of a larger liquidation break. I'll discuss that in the Sunday video, not to be too much of a tease, but it's easier to show this stuff on the charts. The Qs, on the other hand, are showing amazing amounts of relative strength, and that is clearly because of the strength in Apple and Google. I would say that if you look at the Qs, you're in 1, 2, 3, 4, 5, the 6th day of a rally. So if there's some type of a gap up early Monday, probably you're going to want to take some profits. You know, these one thing that a lot of people don't discuss is that markets tend to move on odd number days, like 3-day rallies, 5 days rallies, 7-day rallies. In the 7th day of a rally, straight up off of support, you probably are going to be wanting to look to book profits. I know it doesn't feel good. You know, you want to squeeze the last penny out of every stock, and I'll tell you that you sometimes have to know when you got to book some profits. And I would say on the 7th day of a rally, you're probably looking to trim. Looking to trim. I will say this though: the Nasdaq has now proven itself to be able to make higher highs. It did make this is off of a lower low though, which is a little bit disturbing. It was off of some relative support in the 206s, which was key. It did rally ahead of the 200-day moving average, which was clearly stronger than what happened in the S&P. Some pullback levels that I would be looking to play, and I will be looking on down moves to do put ratios into these. As long as the Nasdaq, if and when it has a pullback, maybe it's on a bad Apple report, maybe it's just on Google profit taking, maybe it's on whatever. Maybe there's some news, maybe Greece is, maybe there's a Greece snafu. I would be saying that the first level of important is the 111s, the 111.16. Anywhere between 111.16 and 109.42, if that range can hold, it's all okay. It's still healthy. If that range starts to fail, it's a problem. I am going to be looking to do put ratios with terminuses below those, sort of below that range. Maybe I'd do a I have to see what I'm going to be able to do. It's really hard to do the put ratios when you have low IV. You kind of like the jacked IV so you can get a larger spread. Like, for example, I'm going to give you one with Apple, for example, with a put ratio. You probably wouldn't want to do like a 121, 120 put ratio, but you might want to do like a 123, 120 put ratio, or like a 125, 120 put ratio if you can get that on. Usually you can't for near dated. Usually 3 points is sort of like the best you can do these days, but I would be looking for some type of a pullback into that range, and then playing. Usually what happens is you'll break out of a range, there'll be a pullback, and you can have a pullback anywhere from the top of the range to the middle of the range for it to still be a healthy move. So I wouldn't be chasing on the 6 or 7 days up, but I would be looking to kind of play by the dips now that it can prove that it can make a higher high. Let's discuss IWM quickly, and then we're going to get into some of these NASDAQ movers. One of the things that is not confirming is IWM, and it did make a lower low. It held the 120.97, the level that I had discussed. We didn't even touch it. One of the things that's been really frustrating, by the way, is that a lot of these stocks and a lot of these indices stop right ahead of where they really should for what I call the more secure launch pad, and they rally, and often those rallies fail because they never really fully checked back to where they should. Think of it as sort of like a slingshot. If you pull the slingshot back far enough, if you get it all the way back and you release, you get that kind of the momentum to carry you forward. And if you only kind of half cock it and you fire, yeah, you get the move, but you don't get the full, impact of of the force that you should have. Always think about that. Think of the slingshot analysis. That's the one that I kind of invented, and it's always been a very graphical thing that that's worked for me. Anyhow, with regard to IWM, I would say that you may have a secure high, swing high here, which would be a little bit dangerous. This stuff never matters until it does, and it's always all at once. But if you want to try something short, you can probably try IWM versus the 126.74 high of day. That was a sort of a high bookended here now by two lower highs. So you may have a secure high to at least to play against. This is just a right or right out type of a trade. If you want to try IWM short against that 126.74, fine by me. I would bless that trade. Over that, you don't want to F around, because the sort of the range that it needs to clear, the 127, that 127.13 down to 126.74. If you get above that, the all-time highs are going to be into play, and you probably get some type of a Fibonacci extension off this last move, and that will not be pretty and not something you want to be sitting short through. So that to me is the line in the sand. Let's get into the Momo here. Google was a little bit frustrating to me because I had been looking to play this long. I had played it a little bit long early, but didn't really play fully for this move. It rallied ahead of the earnings. It rallied like 50 straight dollars, and then only to gap again and go. I have discussed in previous videos that I had been looking for this to get up to the channel high, which is around 618-ish. Yeah, it's almost $700 here. So I think it did actually close. It closed at 699.62. The high of the day was 703. Now, that's a pretty big standard deviation move. I would assume that this stock probably needs a little bit of sideways consolidation here. If I don't believe in chasing these types of moves or stocks, but if I had to have a gun to my head, which I really prefer not to, I would rather be playing Google from the long side than the short side here. There could be some type of a pullback. I will show in the video on Sunday, not to be too much of a tease again, some of the Fibonacci levels that I'd be looking at for pullbacks. That's really kind of, we're in clear air here. I had discussed in tweets yesterday that 691.75 was the 1.618 Fibonacci extension, and we're up there and cleared it. So technically you can go a bit higher, but this is a pretty big move. I'm just sort of one of those people who like to buy on dips. I don't like to chase, just because if this is the top, for example, in Google, and it probably isn't. I don't have good trade location. Like if Google collapsed on Monday and Tuesday and was down $50 or whatever, I don't have good trade location up at $700. What I would like to see, if I were going to play Google here now long for an initiative play, would be for it to go sideways for a few days, like usually the 3-day rule. That's sort of one I've always used. If a gap can hold for 3 days or so, usually it's a little bit more safe. I think that you need to clear 703, which was today's high of days. So the ideal situation you would see is some type of sideways action for a couple of days, consolidate some of these gains in Google, then clear the 703 for the next leg higher, and that's what I would see. If you start losing today's low of day, which was 678, you can probably play for a retracement lower. I will discuss that on Sunday. Netflix reported this week. Holy cow, man. I mean, this stock is just, does it get any more bullish than this? I mean, the thing has just moved in gaps. It's consolidated after gaps. I probably wouldn't be chasing Netflix here just simply because the stock moves so much. There's still about a 15% or so short interest that was in this before the earnings. I'm not sure how much of them are still left standing. I do believe that the stock probably it'll probably need to do the same thing as Google, and that's what it's done after gaps before. It's consolidated, it's gone a little bit higher like today, and then it's consolidated for a few days. So I would say it's sort of holding in there. I don't know if I would initiate a new long here just because it feels like a little bit of chasing to me. I would let this just work off a little bit. It's had a lot of good news out on this. It's made new highs now on declining momentum. You've had the split. I would just give this thing a little bit of time to cool down. It'll probably wind up working higher. I just don't know that it's not going to go lower before it goes higher. My play on this had been to be long the stock into the split and then to be out sort of before the earnings. And I had thought that the Goldman Sachs late upgrade was sort of like signaling the top. That was not correct. It was correct for a day. The stock was down about 3 points into the after the split, so that it wound up being correct. If you sold on the split, you could have taken off, but it really wasn't correct because the stock went higher. I guess I have to, you take the good with the bad. At least I didn't say the short, that's for sure. So yeah, you might have been taken out of some of the profits on this, but I will tell you this. Statistically, that was the right play. This was the example where it wasn't the correct one, but maybe 9 times out of 10 or 7 times out of 10, the probabilities would have favored to probably be taking out. But please book some profits on this if you haven't. I mean, the stock has had a really monster move. If the market does something like rollover, like I had said, the Nasdaq has had 6 straight days up, and there's some type of pullback, Netflix might get a little bit of a schnitzel, so to speak. Apple, is pressed right up against the downtrend line here. You're into this one. This is very annoying. I can't see the. Okay, 120. Oddly, we're going to be talking about my level again. That 129.85. That's right where the downtrend intersects here, roughly, maybe a little bit. We kind of closed right on it, believe it or not. It's been now multiple days of rally, 1, 2, 3, 4, 5, 6 also. So you might get a little bit of a look above here and fail. I still believe, and I know this is going to sound a little wonky, but I still believe there could be some type of a little bit of a shake and bake before Apple earnings, which are on the 21st. If there is some type of a pullback, and particularly if it's like an uglier one, like a few points, shake out some of these weak hand chasers, I'd be looking to be buying that, because the pattern here with these momentum stocks, it's kind of crazy, right? They run into the number and then they run again. So until that plan is sort of shattered, I'd be looking to play for the upside in these stocks, particularly with something like Apple. Apple did wind up having a check back to the lower end of the range, the 119.75. I was actually really surprised that it kind of held the way it did. The market was sort of going to hell, and it checked back. It held exactly where it needed to hold. If there is some type of a pullback, somewhere between the 50 and 100-day moving average, about in the 127s, maybe you get lucky to the 125s if there's like a bit of a bigger pullback. but I would think somewhere within those couple of points is probably the buy the dip spot on some type of a shake and bake play. If Apple just guns it into the print, you know, sometimes you just have to say you missed it. You know, if you're not already in it, you can't you can't always just, you know, be in every move for every stock. I will show this a little bit more on the charts on Sunday, again, not to be too much of a tease. I will say this with regard to Apple. The implied volatilities in the options did go up a little bit today. I had been discussing playing in some of the August premiums because they were still around the 25s and 26s. I believe the 42-day to expiration is still in the 26s, but the others have moved up to the 28s and 30s. I would say that the buy points there, I had discussed hedging today. Actually, I think I discussed it yesterday. I had said to buy the, as you know, hedges, those puts, puts or put spreads. So if you want to protect your longs, if you get a move down somewhere in Apple IV, that's probably the spot to do it. I never like to put the earnings plays on until right before the print, so to speak, just so I know my strikes correctly. Sometimes you get a pre-release or something that happens that shouldn't happen, and it kind of mucks up the trade. So I like to kind of wait until you see the whites of their eyes. But my guess, I'll discuss maybe a little bit more on Sunday, or maybe even on Monday or Tuesday, right before Apple earnings, like really right before there, to about how I'm going to play it on earnings. My guess is I'm going to do something with an upward bias that is short volatility, because once Apple reports that volatility is going to get crushed, the expected move for Apple earnings for next week is about $6.50. So that would take you up to, I think, up to the old all-time high. It may even do something like blow through. I know Icon is still long in Apple. I can't really see him getting out until this thing gets the kind of move that he's looking for. So we'll see. The key for Apple, I believe, is going to be their China metrics and their numbers and some of their guidance, particularly with iPhone. I don't really think it's going to be affected by what's been going on in China, but I mean, who knows? Anyhow, that's that. The one thing I will caveat is that a lot of these stocks, again, have had multi-day moves higher, and you always have to think of your trade location. If you don't have good trade location, you either can take a pass on the trades, or you do it in smaller size. It's not the same if you've bought something after a 6-day rally off of a support as it is as if you buy it in size right at the support or right off of a fib, you know, for the right or right out types of trades. I'm going to get into BABA and some of those other stocks, but I'm going to do that, I think, mostly on Sunday. I will just discuss it quickly here because I just saw some questions about that. I think we may end on BABA. It's right at the 38.2 Fibonacci retracement. The next big sort of level, now that it held 80. One of the things I will say I liked about BABA, and I'm going to talk about the setup. Actually, we're going to do one more after this. We're going to discuss silver and gold quickly because it's a similar type of a setup. So you had a big move down in the Chinese market, and on the 8th, 7-8, FXI made a new low. That was actually the day that I got long the FXI. And BABA did not make a new low. It had a tweezer equal low. It has rallied since then. Today broke the downtrend, and you also have done something new in BABA that you haven't seen in a while. You've made a higher high off of a higher low on a separate leg here. So the 80.21 low held. I had said if it held 80, that area was the right or right out area. And now we are breaking the downtrend. We are now took out the 82.20 swing high, and maybe you get some more rally in BABA. I will say this stock has been an absolute disappointing, heartbreaking piece of oh yeah, it's a family show. We won't get into that too much. It's been a very hard stock to play. It is working right here to the upside. I would think 85 is the next and key level. Maybe it can work its way up to $90. It's a bit of a toughie. But I will say the pattern is starting to shift, which is good. I've heard some funds are buying into this. Maybe it finally starts getting some support again. The stock, based on their earnings, isn't really super duper expensive, although anything China has been sort of guilty until proven innocent. All right, so I got some questions on the stream. I had discussed the other day, I think it was either yesterday or the day before that, about maybe nibbling a little bit of silver, SLV, and I did take a little bit of a tester long in it, and the simple reason was this, is that on Fed days, I don't know, anyone who's been following me for a while knows this, but I use silver as sort of the leading indicator, particularly for gold. If silver is weaker than gold, the gold is going to get smacked. If silver is stronger than gold, it's probably going to rally. This isn't so relevant these days because I don't really play the metals much. I haven't really played the metals much in a couple of years, but I did see something in silver that kind of got my ears open and my eyes wider, and it was the fact that gold is making fresh lows and silver is not. It's contained within what should be a secure low. Now, this is not getting a lot of media play, and it's also not going to get a big leash in terms of my sticking with this trade, a high conviction trade. It's a small trade I put on, and it's based against a 1403 low. That was the big hammer low. It was on big capitulatory levels, types of volume. If we can hold that low with like some type of an equal low or a slightly higher low, I'll stick with the trade, and I would be looking to add back, believe it or not, over that high of day of that bar's range. If we come down and then we can clear 1458, then I would say it's an add, and it's probably an add in size. You don't hear me talk about size much these days because the market has been just sideways and choppy, but if it is sort of a go, right or right out type of thing. Anyway, GLD looking weak. It did have a gap down today. There was on big size. It was a gap below range. Anything below this 109.67 is sort of weak. What you could have with gold, and I'm going to keep my eye on this this week, is that this could be a sort of island reversal, but instead of being on the top end, on the lower side. I think it's called like a morning star, or I think the upside is the evening star, the downside, whatever. It could be an island reversal. It may last a day or two, it's possible. But any type of a gap up above like the high of day, or gap into the range, like if you can gap, like let's say Monday, or maybe Tuesday, Monday's weak again, and then Tuesday it gaps. If you can get a gap over 109.67, which is back into the range, this would be like a false breakdown, and that would confirm my silver play. So let's keep our eyes on that. Anyway, I want to catch a couple of more rays. I am still on the beach here on vacation, so let's wrap there. I'll discuss more of this stuff in the weekend review. So yeah, the props are, yeah, anyway, a quick note on this. My service is being worked on. I had a couple of potential tech. I've had a little bit of some tech trouble getting it done. Believe it or not, it's expensive and complicated to build, and I want to do it correctly. But it will be in the works. I'll keep you guys up to date. Anyhow, if you're not following me, my Twitter handle is @JustinPulitzer. My YouTube channel, if you missed this or caught it, or if you came in a little bit late, is Justin Pulitzer Trades. Be sure to check that out and hit the subscribe button. And let's have a good weekend. And I will talk to you guys on Sunday in a little bit more detail. Anyhow, cheers.